that here we are, coming up on Thanksgiving, and we're still dealing with this coronavirus pandemic. So I know this has been an extremely tough year, one that, I think we're all kind of looking forward to putting behind us. But, good for you, and thank you for joining us today to try and take a little control and hopefully, soak up some information to make the most of our finances in an already difficult year. There's two things that I want to kind of promise you right out the gate here today. The first is that throughout the session today, we'll be able to hopefully share some very timely, kind of immediate strategies that you can jump on right after the call here today and really help kind of improve for the years moving forward. The second is that we're going to talk about a lot of tried and true strategies as well. And these are things that you can maybe reflect on for years and years to come that should be very long-term planning strategies that, just really help kind of empower you moving forward too. So of anything, that's kind of my goal in our time here today. As I had mentioned in the invites, I'm going to try and keep this as close to 45 minutes or so as possible. Happy to go over with some Q&A at the end, but in respect of your time here and make sure you guys can all get out to dinner, I will do my best to keep from rambling. So again, thank you so much for joining us. My name is Brandon Steele. For those who don't know me, I'm a CFP and co-founder here at Mainsail Financial Group. As you can tell, we're located just right here in Bellevue, Washington. And one thing I want to point out before we start jumping into things as well is throughout the entire session here today, there will be little to, well, let's say no mention of products. What I do and what our goal is for this session is really to talk more about strategy. It's more about mechanisms, advice, and tools that you can use to really empower yourself moving forward, as opposed to products specifically. I think that, for our firm, that's one of the kind of key things that we focus on is not necessarily the product side, but more on the mechanisms and strategies. And you'll probably get that a lot through our time here today as well. So really looking forward to digging in. Obviously in 2020, there's been a lot, so it'll be a good opportunity to really jump into that. So as we get started, I want to maybe back up and share with you when we talk about planning some of the areas that we focus on. And this will be kind of a framework for our conversation as we get into the heavy lifting today. So to us, planning is really about 6 key areas. And I think the key to this is that planning should never be looked at in silos. In other words, any change that we make in any of these 6 areas is going to have an impact on at least one, if not the other 5 as well. And so true financial planning is really about making sure that all 6 of these areas are working cohesively, really working towards the same goal to really get you to where you want to be. So I'm going to go over this on kind of a quick, high level view of it. But the first thing that we really look at is your current financial position. So we're going to talk a little bit about this today, but think about this as a snapshot of where you are today, but also understanding where you'd like to be. The whole idea here is to get a very clear picture of where we are and where we're headed before we start making tweaks to try and get us there in a more effective manner. Right? Next, we have risk management. Easiest way to sum this up is this is the defense in the plan. We can have the most solid investing and saving strategy possible, but if we don't kind of lock that back door, something can come along and completely derail all the hard work that we've put in place. So when we talk about risk management, that's really what we're referring to. Next, we have wealth management. I think that this is probably the most common area people think of when they think of financial planning. This is certainly the investments, it's risk, it's, your goal and your time horizon and how do we create a portfolio. But your wealth is also not just your 401k or just your IRA. Your wealth is your home, it's your debts, it's cars, it's jewelry, you name it, right? And so when we talk about wealth management, it's really bringing all of that together. Next, we have tax planning. We're going to spend a good amount of time here on this today. I am not a CPA, so I'm not necessarily, busy during the tax holiday or preparing tax forms year to year. But what I do here is to help look at tax planning now, but also the next 10, 20, 30 years down the road, and really making sure that we're being as tax efficient all the way down the line. Next, we have retirement planning. And I think we're going to take a little different approach to this in our conversation today. I think everybody, the media, the articles you read, you name it, everything is all about accumulation. It's all about what's my number in retirement, but there is very little to no talk about what happens when we actually get there. And, it's usually coming down the mountain that we get in trouble. So we're really going to spend some time to outline how to kind of start to build towards an effective distribution strategy. For those who might be a little further away, that may sound silly or not helpful, but I promise you, the better idea you have of what that's going to look like, the more you can do today to kind of reverse engineer and make sure that everything you're doing is heading towards that goal. And then last, we have estate planning or legacy planning. We'll finish up talking a little bit about this too, but the simplest way to put it is making sure that your wishes get carried out, right? Rather than the state deciding ultimately where assets may go or whatever the case may be, making sure that what you want to happen really does. And then also, the preservation and tax strategies around some of that as well. All right, so before we jump in, this is really designed to be kind of a 2-series session. So part 1 is really going to be our time together tonight, the next 45 minutes or so, where we're going to dig into a lot of strategies, kind of share a lot for you to consider. And then part 2 is going to be an opportunity to sit down, one-on-one with a member of our team and just ask any questions that you might have, talk a little about how some of this may relate to you specifically. So here we are, 2020, just the year of never-ending craziness, right? I mean, I think we're all kind of feeling lost. We're all feeling scared. We're all confused and just frankly tired of this. So our idea through these sessions is to just help as much as we can on the finance side of things, take as much of that stress off your plate as possible. It's funny, I went to the mall just a couple of weeks ago, and it was amazing how packed it was. I mean, for those who know Bellevue, think Bellevue Mall during Christmas time, that's what it felt like in the mall. And it was just amazing to see that. I think it's slowed up a little bit, maybe because it's, pitch black at 3 p.m. I'm not sure, but it was amazing to see that. So I think there's a little optimism, a little tired of, being stuck kind of thing going on. But I think we're all just really sick of this. And the reason I bring all this up is to really help us to focus back on our goals. This year has been a year of distraction, and all of our retirement planning starts with this one key question, right? What does retirement mean to you? And if you don't have that question answered, all the noise we've seen in a year like 2020 or other years in the past, that is all going to distract us and just take us away from where we're really trying to aim. So, think about this a little bit, right? What does retirement mean to you? What do you want that to look like? And I really do think that this is the most important question that we can ask, or you can ask yourself, to really make sure that what you're doing today is going to set you up for a successful retirement. I know it feels like in 2020 here, let me back up. 2019 was a great year in the markets. There wasn't too much going on. 2020 started off strong, and then smack, like all of a sudden we got hit by COVID. The markets took a huge downturn. We've had civil unrest all year. We've had one of the most polarizing elections we've seen. Giant killer bees came to Washington. And by the way, it's only November, right? So it's been just a year of distractions. And I think it has been very, very easy to take off the blinders and just let this all kind of affect us. But the key is, if we can come back to this question and really focus on where we're going, that is going to help you dramatically to get to where you want to be. Can I see a quick show of hands? How many people on the call are within, let's say, 5 years or less of retirement? Okay, looks like we got a couple. How about if you guys can drop your hands? How about let's say 5 to 15 years? Okay, we got one couple there as well. And then how about 15 years plus? Okay, good. So we have a wide audience here, which is good. And I think wherever you're at, you're going to get a lot out of this. Again, we will talk about distribution, but I promise you, the more you know of that, the more you can kind of gear up for what may be on the other end of that corner there. So let's kind of jump right into it. And the first thing I want to touch on is really to share some risk considerations. We're going to bake a lot of our conversation into these different categories, but there's really 5 risks that we see very often. The first is longevity. I don't think it's any secret at this point. Most of us know that we are living much longer than we used to be, right? We go back when like Social Security was started, things like that. It wasn't very long that those benefits had to last. We retired and usually passed away within a couple of years. Nowadays, not only are we living longer, but a lot of us are also retiring younger, which is awesome, right? It means that we have a long time to enjoy in retirement, but it also means you've got a long time to make sure that that money will last you. And, with what we've been seeing lately, with some of the stimulus and all of the stuff that we've been doing to try and help out during this crazy year, we're starting to see some early signs of inflation. And even, if you are familiar with the Fed, they are even targeting higher inflation right now. So that is starting to become a bit more of a consideration. I don't necessarily expect it to be anything out of control, but I think it is something to really watch, because looking backwards, inflation really hasn't been much of an issue, and it certainly might start to kind of creep up on us a little bit here moving forward. Next, we have withdrawal rate risk, which we'll talk about here in a little more detail. We have timing risk, right? When do I retire? What happens if I retired, let's say March of 2020? Or what if I retired in 2007, right? We have market returns. When do we get market returns and how the sequence of them affects us? And then one of the biggest ones that come up is unexpected expenses. I would almost call this expected unexpected expenses. You can almost guarantee that these will come up. So it's really important to be prepared for them. So the first thing that we'll talk about is withdrawal rate risk. So what you'll see here is you'll see 2 different investors. Both of them started with, as you can see, with $500,000 of assets. They both got the same returns, but as you can see, the difference is that one investor decided to take out 4% of their assets per year to live on. The other, just a slight difference, only 1% difference, decided that they were going to be able to take out 5% to live on in retirement. As you can see, it's amazing. I mean, the person taking 5% ran out of money in 23 years, and that may get you through. That's all well and good, right? But look at this difference between the 4% and the 5% investor. The 4% retiree not only lasted over 23 years, but you can see that money has actually grown. So it may create an opportunity for, for their heirs or kids or charities or, whatever else may be important to them as well. And I just think it's amazing to see just that small difference and how much of a discrepancy that it creates. And, one of the reasons that this is so important is because of the timing. And we'll get into this more here in a little bit. But for instance, in 2020, we saw this huge drop back in March. Think about it this way. If you're taking 4% on 500 grand, that's 20 grand a year, right? So that's all well and good while your account value is at 500,000. However, back in March, if you were invested aggressively, let's just say that dropped to 250, you still need that same 20 grand a year to make ends meet. But now that's almost 10% of your portfolio, right? I guess 8%. So it's a much, much bigger chunk. And the challenge is when the markets recover back in May, it's a much bigger hole to try and climb out of. So that's why this really has such a big impact, is not only how much we're taking, but also the impact of market fluctuations along the way too. Maybe just a quick show of hands. Does anybody on the call, does anybody have any friends, family members, who retired in 2008 by chance? All right, it looks like actually nobody. So that's probably a good thing. If so, a lot of those folks may already be back working. The challenge of the timing is really important, and we'll talk more about ways to manage risk ahead of time here in a little bit. But retiring in a bad year can really be a difficult hole to climb out of. And I think that this next slide shows that really well. So again, we're looking at 2 different investors. What you'll see is both start with $1 million in retirement. Both average, as you can see, the same rate of return. But what you'll see is investor A gets good rates of return early on in their retirement, whereas investor B is the opposite. They get bad returns early and then good returns later. As you can see, just by simply flipping the order of returns, investor A, after 10 years, even with withdrawals, actually ends up with more money than they started with, whereas investor B, just based on the timing of returns, actually ends up with significantly less, right? Almost half, actually, as much as investor A. So this is really important, and this explains why this is so impactful. Again, we'll come back to some ways to prepare for that, especially for the folks on the call who are a little closer. But as you know, when you get closer to retirement, you may want to start peeling some risk off the table so this doesn't have as big of an impact to you. All right, let's get into the heavy lifting here today. We want to spend some time talking about tax planning because there's so much legislation and so much change that's happened here in 2020 that this is really an area where we feel like there's a lot of opportunity and also a lot of kind of challenges that may be on the horizon if not addressed properly. So before we get to that, I want to make sure to kind of get everybody on the same page, and we want to talk about the different ways that any investment can be taxed. So within investments, you have the actual holdings themselves, like how you're invested. Don't worry about that for now. What we're really talking about here is that outer kind of tax wrapper that really dictates the way money is taxed coming in and out. Okay. So first, in kind of the top left section here, what you'll see is what we'll call taxable accounts. So the way this type of account works is after tax money goes into an investment, and essentially you are taxed as you go on that investment. So every year you might get a 1099 saying, you know, if this is a savings account, for instance, congratulations, you earned 10 cents, right? All of it's taxable. You know, if it's a stock or bond portfolio, it may be based on when you bought and sold, but generally speaking, you're kind of taxed as you recognize those gains. Okay. One of the advantages to these types of accounts is total flexibility. You can not only put in as much as you want whenever you want, you can also take out as much as you want whenever you want. So it creates a lot of opportunity for, you know, different types of goals that aren't just retirement. But also allows you to be a little more tax efficient if you have some of these buckets in place. The challenge, of course, is now we're paying taxes as we go, as opposed to what you'll see here in a minute where we can kind of defer some of that. Speaking of deferral, next we have tax deferred. So what this does is we put money into this type of account, and when that money goes in, it is before tax, or we get a deduction on our taxes for that contribution. Now, what happens from there is instead of paying taxes as we go, all the earnings, all the growth, all that stuff is all deferred until we get to a retirement, big hint. And at that point, every single penny that we pull out is going to be fully taxed as ordinary income. What am I? I'm sure a lot of you guys already are starting to put the pieces together on this, but this is your traditional like 401ks, 403bs, IRAs, you know, pensions if you happen to have one. You get the idea. So the benefit here is when we put money in, we're going to get a big tax break, right? We get to deduct that income or that contribution off of our income. The challenge is, in a way, we're kind of creating a ticking time bomb. You know, the future growth and the contribution are all going to be taxed down the road. On top of that, the IRS has a little separate plan for you too. And if you have money in this type of account, they're going to make you take it out when you hit a certain age, whether you need it or not. So more taxes there too. Next, we have tax-free, and nothing is necessarily tax-free, so I should have a little asterisk next to this. But what we're talking about here is the way it's taxed, or sorry, the way it grows. So this is kind of like the tax deferred, just flipped on its head. Instead of getting the deduction early on, we do have to put this money in after tax, but the benefit is from there on, every single dollar of growth, every single dollar of contribution, you name it, when we get to retirement and take it out, 100% tax-free. So that is a huge, huge benefit, right? Think about it this way. If you invest $100 today, ideally that is worth much, much more when we get to retirement. And in this case, in the tax-free case, all of that money is totally tax-free when you get there, right? So as you can imagine, that can be really powerful, especially if you've got a lot of time on your side to get there. That's the pro. Now, what's the con? The con is, of course, that we're losing the tax deduction today, and we'll talk more about this here in a minute, but kind of the general rule of thumb that you hear is that you may be making more today than in the future, so your taxes may be higher. We'll talk, we'll kind of kind of break apart that myth here in a little bit, or that stereotype, but that's generally how the two differ, okay? So quick show of hands, who thinks the tax deferred is the best vehicle? I think I see no hands. Maybe I got too excited about the tax-free and gave that one away. But it's funny because, most people that we talk to find that nearly all, if not all of their assets are in that tax deferred bucket. Now, there's nothing wrong with that bucket. Just like you diversify your investments, I think it is also important to diversify your tax implications in the future. And that way, whatever's thrown at us, you can kind of bob and weave and make the most of what's going on. But I would agree. I don't think tax deferred is necessarily always the best. I think that you really need to take a little time and consider how all this stuff relates to you specifically and what you're trying to accomplish to figure out the right mix of the three. And just to be clear, that does not mean a third, like 1/3 in each bucket, but it is important to maybe have some in each category, and that'll allow you to have a lot more maneuverability when the time comes. All right, so let's talk a little about how we can use some of these buckets. And I'm going to tie them into some changes that happened to us. We had no choice in this. They were forced kind of upon us on legislation, and what we can do now to maybe prepare or make ourselves a little more effective because of that. So the first thing that came into play was something called the Secure Act. This went into effect literally January 1 of 2020. And I think, for a couple of the folks that I know on the call, I know we've talked about it before. For the folks who I'm not familiar with, hopefully you've heard of this, but honestly, it snuck under the radar because of all the craziness we've seen. So don't feel like, it was something you had missed. It probably just kind of snuck by, but it is important. And really there's a lot to it, but one of the biggest things that came out of it is the way that accounts are passed to your heirs. So when a retirement account, and just to be clear, I'm not talking side to side, so spouse to spouse, but let's say it goes to kids, for instance. Before this went into effect, when you passed on a retirement account to your kids, the account had to be distributed every year, but it was based on the heir's lifetime. So especially if it went to a kid or maybe even a grandkid, for instance, that was not a whole lot because they still had a long life expectancy. So just a small amount per year needed to be actually distributed. The challenge now is they've totally revamped that. And instead of spreading it out, all of that money, every single penny, needs to be taken out within a 10-year period, or there is a huge penalty. So you could take, let's just say $1 million went to your kids. Kids could take out $100,000 a year for 10 years, or $1 million all at once. But no matter what, however they do it, all of it's got to come out within that 10-year period. So you might be thinking, well, what's the challenge? The problem here is if this is pre-tax dollars, all of those dollars are going to be taxed when distributed, and that's based on ordinary income. So if your kids are also working, they may be losing half overnight just to taxes, right? Now, the Roth still is under these requirements. However, the Roth is tax-free. So the impact to the kids is really not going to be as large because they still have to take that money out, but it's not going to impact their taxes at the end of the day. And maybe they just reinvest it or do what they would like to do with it from there without losing, nearly half just based on the tax wrapper around it, if that makes sense. So that's something to consider. I think maybe the bigger concern here or thing to consider is it's very clear that when legislation changes come into effect, it's clear where it hurts, and it hurts in accounts that are going to be taxed in the future, right? Because if we have our assets in tax-free dollars, yeah, this means that they've got to take it out earlier, but it's not really going to impact them. If tax rates go up in the future, yeah, it means tax rates are higher on some of our dollars, but if it's tax-free, it doesn't really impact us. You get where I'm going with this? So just be aware of that. I think that, if anything, the tax-free or the Roth assets just provide a little more flexibility. And for now, this could change, but let's say a little more control as well. I think another thing to really touch on briefly with that is this taxation in the future. Can I see maybe a quick show of hands? Who thinks that tax rates may be higher in the future than they are today? All right, it looks like everybody is on that page. And I think I would agree with you guys, especially, I think even regardless of what we saw this year with the challenges of COVID, it's pretty likely taxes were going to go up. They are at all-time lows. They've gone nowhere but down over the last 30 years or so. And with our deficit, it's got to come from somewhere, right? Add on top of that, the nearly $10 trillion in stimulus and Fed spending and all that stuff. And I think, we've really got to figure out how to balance this budget somewhere. And it's very likely, I think we all know, politicians do not like spending less. So it's very likely that we see taxes go up at some point in the future. So another concern, right, is if we put all of our money into pre-tax or tax deferred, sorry, let me stick with the terms on the board, we may be setting ourselves up for a higher tax bracket regardless of our income now and in the future too. So keep that in mind as well. Now that we are starting to see a little clarity in how the elections are going to shape up, it looks very, very likely that Biden is taking the presidency and the Republicans are keeping the Senate. So where I'm going with this is it looks like we should have kind of a house divided, right? Balance of power, which is what this country's all about. It's been historically a good thing for the markets. I'll talk more about that in a minute, but it probably means very little change in taxes for at least the next 2 years. So while tax rates are low, maybe a good opportunity, especially this year. I'll talk some more about this year as well, but let's say the next couple of years, it may be a good opportunity to start thinking about this stuff. Because also, if you remember, the Tax Cuts and Jobs Act that went into effect a couple of years back, that is set to sunset in a couple of years. And basically where I'm going with this is with a balance of power, it's very unlikely with what we know today that something would change before then. So it's very likely that we see those tax rates just go up just by default, if anything, if that makes sense. A couple of years from now too, when the Senate runs again, and let's say Democrats were to take the Senate, as you guys know, Biden was running on raising taxes. And so that's even more reason that you should consider this, because, we may see an increase at that point as well. So just really think about that. I think, the takeaway from all this rambling is we are in low tax rates today. They may be higher in the future. So really think about how to maximize this time that we're in to set yourself up for some success down the road. All right. And keep in mind, income is not the only dictator of how we should be investing, whether we use tax deferred or tax free. Think about tax rates in the future, right? Think about your goals in retirement in the future. This goes back to our first question. What does retirement mean to you? If you don't necessarily want to decrease your lifestyle in retirement, you would like to live a similar lifestyle, that doesn't necessarily mean that your income is going to be lower in the future either, right? So just kind of keep these things in mind. And if it makes sense, consider these few years to really take advantage and get money in at potentially a lower tax rate than we may see in the future. The last thing that I want to touch on the tax considerations is another piece of legislation that went into effect this year. This took far more media attention than the Secure Act did. This is the CARES Act. So you may have heard that term. Basically, this came into effect due to the coronavirus. There's a lot to it, and I'm not really going to get into the details there. We could spend an hour or two on that alone. But what I do want to touch on is the impact to required minimum distributions. I mentioned earlier that in the tax deferred vehicle, the IRS has a separate plan for you, and they will make you take money out of those accounts, whether you need it or not. In 2020, and for anybody who maybe has a beneficiary inherited IRA or something along those lines, you may know this already, they had stopped that requirement. So this year, you do not have to take those RMDs. The benefit is if you were in that boat, this may mean that your income is slightly lower based on the difference between your RMD years and this year. So it may give you an opportunity, again, to get more into that tax-free bucket, where most likely in 2021, we may see those come back. It could change, but just the way things look right now, most likely we'll see RMDs come back next year. All right. And even if you're in your 70s and you're being forced to take those dollars out, this might be a good opportunity if estate planning is important too, which we'll come back to in a little bit. All right. I am going to start to move on here a little bit. Hopefully that gave you enough information around taxes. I'm sure I put half you to sleep, but now let's get into some more exciting, sexy things around investing. So what you'll see here is really the broad spectrum of different ways that accounts can be positioned, right? So when we talk about investing, really what you'll see is different allocations on the left from conservative, so somebody who is mostly in bonds or cash, all the way to the right where we have aggressive, where it's mostly stocks or equities, all right? Now, the way that you feel about risk, how much time you have until retirement or whatever goal you're investing towards, all those really factor into where you should be on this scale. What I will say is if you're a little closer to retirement, typically like a balanced type of portfolio can be a really good place to be, because that's going to give you, think about the stocks as kind of like the spring, right? It's going to give you the opportunity for growth to keep up with some of the inflation challenges. And then think about the bonds being like the shock absorber. So it helps minimize all that up and down to kind of put like bumpers on your portfolio, if you want to think about it that way, and just really smooth that ride out. And that's why you see that balance can be really helpful, because it's really a good mix of the two, right? But wherever you fall on this category, or on this spectrum, I should say, the key is that what you see here is not designed to be the end all be all. This is kind of like the way that we set up a portfolio to win the war, right? This is the long-term asset allocation. This is what's going to get us to retirement or the new home or that golf trip. Sorry, probably see where I come from, but whatever it may be, this is what we're aiming for on the broad spectrum, right? However, and especially this year, we've seen that there are battles going on every day almost, but every quarter, every month, every year. And so this is meant to be the starting point and the guiding kind of framework, but there should be some slight tweaks up or down over time to really take advantage of opportunities, and maybe more importantly, to stay away from risks. Risk is not always the same, right? We'll talk more here in a little bit, but there is, some concerns around interest rates right now. That risk was not relevant 20 years ago when interest rates were high. So those are some things to consider, right? Now, as we kind of expand a little bit more on the allocation side of things, I think it's important to kind of talk about where we're at today. If we go back in 2020, again, we started with a great run up in the market. We saw this quick drop and just as quick a recovery. Like we just bounced right back out of that thing. And now we've kind of gone sideways, slightly up sideways for a little while here. But again, there are different risks going on right now. If you're closer to retirement, it's very important to be cautious of what you own in your bond portfolio, because interest rates are very, very low. And when interest rates rise, bond prices actually fall, meaning your portfolio could drop when interest rates rise. So there are some things like that to really consider right now that may have a big impact on the way that you kind of position things. I think as we look forward a little bit into 2021, it feels like finally there's a little certainty. Like to cap off the year, it's funny to say that with COVID going on, but given what we've seen this year, it actually feels like we have some sort of clarity, some sort of certainty on what's ahead. And it's very likely that there's not a whole lot of change ahead of us right now. It's very likely interest rates are kept semi-low. Again, I think if you're in retirement, you need to be cautious of that, but I don't see them going through the roof. And very possible we see 2021 as a kind of a good year in the markets because of some of that. Another thing to kind of touch on real quick as we wrap up some of the conversation around the markets is with this V, we've started to see earnings really do well too, which is kind of what we've needed for this next leg of the market. So hopefully that continues. It's just really beating expectations is all we've got to do. And expectations were so low that it was a very easy hurdle, but it's a good thing. It's what we needed, I think, for a lot of these companies to kind of continue along this path. So you probably caught this a minute ago, but I love golf. Like, that is my thing, and it's been a lifesaver through this COVID challenge. But I like to think of the markets kind of similar to a golf swing, just with what we've seen lately. So when you swing a golf club, you hit that ball, you have this like instant jolt, this instant jump off the club face for the ball. It's all that energy just like picks off and takes off, right? So you get a whole lot of energy coming out quick, and then as that ball gets higher and higher, you start to see some of that energy come off, and it's still going, right? But that energy is just not as vast. And I think that's what we're starting to see with the markets. We had this like instant jolt back up where we just saw that quick rebound. And now we're starting to see this kind of slow upward trend, and hopefully that will continue moving forward. There's no way that you see that kind of continued energy forever. And so this is very natural. Now we need, things like earnings and interest rates and things like that to help us out to kind of continue this next leg. But that's kind of what we've seen so far, and hopefully what we'll see to continue moving forward here into 2021. Right. So biggest takeaway from this is that, again, we've had a big rebound, maybe a little slower growth moving forward. But it's really important to kind of keep an eye on things as well, because as much as I am kind of backing certainty, we still have this thing called COVID out there. My biggest concern is potentially, states start kind of peeling back on what they've opened up. And that would be very bad, as you might imagine, for the economy. It's what's kind of happened over in some other countries, and it's really impacted things. So that is the biggest concern that is still out there. So very important to manage risk still, even with everything going on. All right. Now, one of the other things that I want to touch on, especially in a year like this, is something called rebalancing. Can I see just a quick show of hands for anybody ever heard of this term, rebalancing, by chance? All right. It looks like maybe half and half. So rebalancing is a really important way to structure a portfolio, or an important mechanism in a portfolio, especially in a year like this where we've had really good times and really bad times. Our portfolios can get totally out of whack. So let's say we're that moderate investor. We're looking at a 60-40 stock and bond portfolio, and that's where we're really comfortable. It's what we need to win the war, right? What can happen is, as you see in a year like this, let's say that was our portfolio back in March when the markets were really down, and then we have this huge recovery in the stock market. Now, all of a sudden, instead of being 60-40, it's possible that our stocks have far outweighed our bonds. At this point, maybe it's more like 75-25, for instance, right? So the challenge is what can happen if the markets pull back, right? If we're at 75-25, number one, we are way too aggressive for where we probably should be. Number two is if the markets pull back, all that gain we just picked up, we're going to lose. It's going to wipe it right off the table, right? So it's really important to consider rebalancing, where basically what we do is we take off the chips from that stock portion that did well and reinvest them into the bond portion that maybe was a little slower. What that does is it gets us back to where we should be. And it also kind of, it's almost like a guaranteed way to buy low, sell high, if that makes sense, right? Because what you're doing is you're getting your allocation proper, and then as you receive gains, you're pulling chips off the table. So use this, please use this. This is like the biggest thing, I think, especially in a really volatile year like this, to make sure that you're kind of keeping focused and keeping track on the long term. All right, let's get in a little bit to distribution. When we talk about retirement, again, there's a couple keys here. And really what we want to focus on a little bit is starting to think about what that distribution phase may look like. So wherever you're at, the very first step in proper retirement planning is to focus on your goals. What are we trying to accomplish? Like, what is retirement going to look like? Where do we see ourselves? All that good stuff. From there, I would suggest breaking out your expenses into two categories. We have needs and we have wants. So what's an example of a need? Retirement needs might be things like housing, right? Food, water, golf. insurance, like you get the taxes maybe, right? You get the idea. Whereas wants are the fun stuff. We didn't work so hard to get to retirement just to survive. We also want to enjoy our life, and maybe it's traveling, maybe it's golfing, maybe it's maybe it's charitable interests. I mean, whatever the case might be, those are some of the things that we've kind of built up over the years so we can also enjoy those years of retirement. Once we have that pretty clearly defined, then we can start to match up our expenses with different income sources. So when we look at needs, it would be important to match up needs with dependable income sources. Anybody here happen to have a pension, or did have a pension, or will have a pension by chance? Okay, looks like we got a couple. It's funny, those are becoming more and more rare, as you probably know, especially for the folks who have one. It's funny, not too long ago, it was a situation where we worked throughout our lives, and basically we were retired, right? The company, the government retired us in a way. We were given a pension, we were given Social Security, and that was kind of it, right? That provided for our lifestyle moving forward. Now, we don't have nearly as much of that. So it's kind of a good news, bad news, right? The good news is we have a lot more control. The bad news is we have a lot more control. But regardless, when we talk about needs, dependable income sources are important to match up. Pension is a very good example. Social Security, don't laugh, is a good example. Think about, bonds, for instance. Something that produces some guaranteed income is where we see that. On the flip side, with our wants, we can match that up with the other income sources, the IRAs, the Roth IRAs, right? Our more investment accounts where maybe it's more stock driven. And the whole idea here is by matching up our needs with dependable sources, we know just for waking up out of bed that our housing, our food, our clothing, all that stuff is taken care of. Doesn't matter what happens in the markets, we are good. On the flip side, on the wants, if the markets tank, yeah, we may not be able to go on that extra trip. But if the markets do well, maybe we get to travel a little more that year or something along those lines, but we're not getting kicked out of house and home because of the market fluctuations. Excuse me. All right. And then all the while, there is this big category of unexpected expenses we need to pay attention to. This is, we're at home taking care of mom and dad, and knock on the front door, right? We go answer the door, and our kids are back moving in, right? It's roof repairs, it's home improvements. It's one of the biggest ones that we see is something called long-term care, right? Which is not covered by traditional Medicare or health insurance and can be a very large expense. So consider these expenses in your plan as well. Make sure you have a little slush, so to speak, for them, and maybe some tax efficient strategies that can help prepare for these types of expenses. All right, as we wrap up, the last thing that we want to kind of touch on is this estate planning side of things. So one of the questions I want to kind of pose to you guys to think about is, well, who needs estate planning, right? That's only for people with a lot of money, right? The truth is, every single person needs some level of estate planning. Certainly, if you are the former, where you do have a lot of assets, things might get a little more complicated. You may need a little more complexity around it. If you are just getting started and all you have is an Xbox, maybe it's as simple as writing down, my brother Jimmy gets my Xbox if I pass away, right? But regardless, everybody needs some level of estate planning. And when we talk about estate planning, there's really 3 phases to it. The first is the creation, which is where we are all at today, right? This is the accumulation phase. We are all there until we pass away. It's building up our assets. It's growing investment vehicles. It's collectibles. It's you name it, right? That's all part of our estate. Then we have the distribution phase. Who gets all this stuff now, right? And then very last is the preservation. So what do we do to maybe make sure that taxes don't eat into it too much, or that some of the legalities are covered so that it really is handled efficiently? And when we talk about this, there's a couple of ways that assets can pass. The first is by law. So when I say by law, this is what you typically see with a bank account, an investment account outside of retirement, something along those lines, maybe a property where it's structured with, let's say, joint tenants, right? And really what this says is in the way that the deed or the account is structured, whatever it is, there is more than one name on that account. And typically this can help so that if one passes, the other can just kind of assume the account. Makes it much, much easier. Second is by contract. I think this is probably the most common form of the way we see property pass. This is things like beneficiaries. And please, 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 especially end of the year is a good time to do it. Please make sure to review your beneficiaries from time to time. I can't tell you how many times I've seen them out of date and very, very upset family members, in those scenarios. So please make sure to review those, but that's the most common, right? We'll see those on retirement accounts. We'll see those on insurance policies. You get the idea. We also have trusts in there, which we'll talk about here in a minute. The third way it can pass is by will, right? Where maybe we write down where things go. Now, typically, if there is an account that's either got some sort of joint tenancy or a beneficiary structured on it, whatever the case might be, those are going to trump the will. Okay, so keep that in mind. Just because you wrote a will more recently and that changes who you dictate gets the IRA. If your IRA's beneficiary is still old, most likely it's going to go to that person, and there's going to be a little bit of a fight, I guess, at that point. And then lastly, and the will will go through this as well, but in absence of all this, we have something called probate or state laws. So a quick show of hands one more time. Anybody ever dealt with probate by chance? Okay. We have one person, so you guys are very lucky. If you ever have dealt with probate, trust me, it is not something that you want to deal with. It's a very, very slow, very, very long, very, very tedious process. Anytime you get attorneys, especially states and governments involved in all the above, as you might imagine, it can take some time and it can be very stressful. So it's not something we want to strive towards. By making sure we have wills, beneficiaries, trusts, contracts in place, you can avoid a lot of that. So I think that's really the key here. So there's a few considerations, and I'm not necessarily going to go into each of these today, but these are some of the areas that you may want to consider when we talk about estate planning. We have last will and testament, who gets my stuff, power of attorney, who can make decisions if I'm not able to. One thing that I do want to touch on is special needs planning. If you have kiddos or family members with special needs considerations, be very cautious in how you structure how assets go to them, because if they are receiving state benefits, you may think that you're doing the right thing by giving some assets to them at your passing, but you may completely disrupt some of those benefits that they're receiving. So be very careful with that. Adam Leibson, co-founder in our office, actually is a specialist in special needs planning, but there's a lot to it. And then trust documents as well if needed, right? And I'll show you where that can be really helpful. So when estate planning really becomes important to a level of complexity is when we start talking about estate tax exemptions. So as you're looking at this, please understand that the estate tax exemption right now is much higher than it typically is. As you can see, it's just a little over $11 million. And really what this means is that if you have over $11 million in assets when you pass, anything above that level is going to be taxed at the estate tax level. Now, I realize that's a big number, but keep in mind, as you can see back in 2010, this was changed. And in fact, not too long ago, it was, I think, close to $1 million on the federal level. Also, in Washington State here, it's significantly lower. It's somewhere just around $2.5 million. And I realize that may still seem like a lot, but especially around here with property values, you may own it. By the way, your estate is everything. I mean, everything. So you may own a home, you may own a rental and have a 401k, and all of a sudden you're above that $2.5 million, right? So if that's the case, this is something to really pay attention to, because as you can see, it is taxed heavily, 40%, and it's due quick. It's due within 9 months of passing, 40% within 9 months. So there are some ways to handle that. One of the areas that you can consider is around trust, which I'll get to here in a minute. One's around gifting, but also keep in mind what we talked about earlier is that if the Senate does go to Democrats in the future and taxes do go up, one of the other things that Biden was running on is also reducing the estate tax level. I don't know that it would ever go back to $1 million, to be honest. So there may still be some wiggle room, but while the estate tax level is high, while there's a discrepancy between state and federal levels, it may be a good idea to start thinking about some of these things if this is something that you need to worry about. Thanks so much for watching our webinar today. We hope the information that you were able to soak up was really helpful and found you in a timely manner. Hopefully through the content today, you got some strategies to not only implement right away, but also some things to really consider all the way down the road. I think a true financial planner and true financial planning is really about not only taking advantage of things going on in the current environment, but also weeding out the distractions, really making sure that we have a long-term focus and a vision to really get us to where we want to be and understand exactly where we're aiming. So our goal and how we help our clients is really to help not only with those short-term, but also balancing that long-term view as well. Again, hopefully this was really helpful. There should be some things that you can implement right out of the gate, but we also want to be here to you as a resource in case you have any questions. So whether you have questions on anything we covered here today, you want to talk about some of the material and how it relates to you specifically, or you do want to maybe spend a little more time, talk a little bit more about planning and a bit more hands-on approach and how we might be able to help, please reach out. You can go to our website directly. That's www.mainsailfg.com. That's mainsailfg.com. Or you can also email us directly at info@mainsailfg.com. Again, info@mainsailfg.com. Thanks so much for your time. We hope the information was helpful and look forward to talking to you soon.